operates in the European low-cost short-haul aviation industry. Within this industry, easyJet competes as one of the leading low-cost short-haul carriers with 23 competitors, but mainly competes with Ryanair, Air Berlin, Norwegian Air, Vueling Airlines and Thomson. This group of 24 players operates on a very different platform from that of full-service airlines. They preserve the concept of low cost into their organisation culture and offer low fares in exchange for eliminating many of the traditional passenger services. This group has reshaped the competitive dynamics of the short-haul market in Europe. It has been largely responsible for the increased growth in air transport activity over the last 15 years, as industry market capital for 2012 was over 20 billion and industry volume sales was over 30 billion. In analysing the industry using PESTLE, there are two key economic factors impacting the industry. Firstly, government plans to raise air passenger duty in line with inflation from April 2013. This has key consequences for the industry as it could begin to impact consumer flying behaviour and put pressure on airlines to find new ways to keep costs down. Secondly, fuel price volatility represents a threat to the industry. The price of oil has climbed 12% since the previous forecast. However, the industry must be cautious about increasing ticket prices to compensate for the higher costs. A 15% rise in ticket prices would cause a third of flyers to fly less. The response suggests that the impact of fuel volatility puts the industry at risk of becoming unprofitable. One key political factor impacting the industry is new environmental regulation in the form of the EU's emission trading scheme. This sets requirements on the airlines to pay for their carbon emissions in accordance to the scheme allowances. As a result, the BBC report that this new regulation will cost airlines £14 billion over the next 8 years, which places an increased pressure on the low-cost airlines, similarly to the economic factors discussed, as target consumers are ultra-price sensitive. A key factor for success would be for the airlines to continue to find ways to better manage costs and operating expenses, which highlights opportunities for the industry. For example, adopting IT applications that peel away cost and drive value. For example, kiosk and web can be replaced by cost-effective smartphone and tablet applications to add value. Examining the attractiveness of the industry using Porter's 5 forces, it can be identified that in an intensely competitive environment, airlines seek to protect their low-cost market by creating barriers through economies of scale and brand awareness. Such barriers, together with the industry requirement of large capital investment, give rise to a low threat of new entrants. However, the market share of air travel has dipped slightly, whereas sea and tunnel transport with high-speed rail and low-cost coaches have risen to 21.1% in 2011. This combination with the growth of video conferencing as a replacement for less essential business travel highlights the growing threat of substitutes. Moreover, technological advancements enable consumers to gather a greater amount of information on destinations and prices, which has in turn lowered switching costs. The increasing use of IT has also led to the elimination of intermediaries in airlines' sales. As a result, technology has increased the power of customers while reduced the power of suppliers. Therefore, despite such high threats of substitutes and increasing bargaining power of buyers in an intensely competitive environment, barriers to entry remain high and the industry has outperformed the market in terms of passenger demand. This highlights the attractiveness of the market. Also, even with intense competition, industry players behave in an oligopolistic manner by imitating each other with respect to pricing strategies and technological innovations. Therefore, future industry attractiveness relies on airlines finding ways to deliver a balanced combination of a differentiated service and low cost, while keeping logistics simple and cutting turnaround times on the ground to maximize revenue-generating airtime. With 7.9% market share of the airline industry, easyJet has increased volume sales from 3.452 million in 2011 to 3.746 million during this financial year. This has allowed the company to attain a 62.18% increase in stock market value from last year. Consequently, in relation to the key factors for success, it is evident from using the resource-based theory approach that easyJet has successfully created sustainable competitive advantages through their core competencies, which have allowed the company to be cost-effective and provide an efficient level of service. They also use unique resources such as a young fleet of airlines which are cheaper to run with high-density passenger seating. easyJet also meet the key factors for success through its core competency by operating with high brand awareness over 547 routes, allowing the company to be competitive with strong positions in key markets such as London, Milan, Madrid and Paris. easyJet is further identifying ways to better manage costs through technological innovations. In 2011, easyJet was the first commercial airline to trial unique resources with nanotechnology coating on their aircrafts to reduce drag and increase fuel efficiency. These core competencies and unique resources are difficult to imitate, but given the oligopolistic nature of the industry, competitors can acquire the same resources, which is a key weakness of easyJet. They must focus on making their resources and capabilities durable, hard to transfer and replicate. Another serious weakness is that the proportion of easyJet's cost base is determined by changes in the external market. However, easyJet's strengths, focusing on its core competencies over threshold competencies, will allow the company to remain competitive with low fares and be well positioned to deliver a good result for shareholders, as this year's return on capital employed has increased by 4.1% to 16.8%. Considering our analysis, easyJet has the right mix of operational procedures to run a successful, profitable airline through its strategic positioning in low-cost leadership. To enhance its competitive position, easyJet should not try to change its model and try to compete with other full-service airlines. Doing so would dilute easyJet's focus and prevent it from leveraging the competitive advantages that have served it well thus far. Average fares have gone up across the industry due to tighter capacity regulations and fuel costs, which were up 22% in the first half of this year. As a result, oil price is a key challenge for the future, as it is expected to stay high. Another key challenge is that passenger growth is slowing down as the European market becomes saturated, and therefore easyJet will need to find new opportunities for growth. However, the robustness of easyJet's competencies can allow the company to replicate its success to new markets and achieve greater economies of scale and greater market share to overtake leading competitor Ryanair.